Welcome, and thank you all for joining us for this episode of the Crexi Podcast, an insider's look at all things commercial real estate. In this show, we cover a broad range of topics that cater to CRE newcomers and industry leaders alike. I'm your host, Ashley Kobovitch, Director of Partnerships at Crexi, and today we are thrilled to sit down with Blake Janover of Janover Inc. A little bit about our guest. Blake Janover is the founder, chairman, and CEO of Janover Inc., a NASDAQ-listed company, JNVR, revolutionizing the commercial finance industry, particularly multifamily and commercial property loans, with its AI-enabled B2B fintech platform and its accompanying suite of products, including enterprise SaaS and InsurTech. With over 20 years of entrepreneurial experience, Mr. Janover has expertly navigated multifamily and commercial property finance through multiple cycles, having involvement in billions of dollars in transactions and employing hundreds of people across the globe along the way. Mr. Janover's expertise and insights have been recognized by major media outlets. He has been featured on Forbes, Bloomberg, and has multiple appearances on the multi-Emmy nominated Big Biz show. He is a Harvard Business School alumnus and participated in their inaugural fintech program. Mr. Janover is an active member of Young Presidents Organization, YPO, sitting on one of its boards, has been an official member of the Forbes Real Estate Council, an on-deck PropTech and Scale Fellow, and an entrepreneur in residence at Florida Atlantic University, and continues to lecture in his free time. Blake, welcome to the podcast.
Thank you for having me. We need to shorten that bio. That's a lot.
It's amazing. You've obviously had a huge track record of success, and our listeners want to know everything about you. So we're really, really excited to sit down with you and learn more insights from your extensive career and success. So thank you so much.
Thank you, Ashley Kobovitch.
Appreciate you. So Blake, let's get right into it. I know we just covered your background, but I'd love to learn more about your career path and lessons learned along the way. So tell us a little bit about where you're from and how you first got it started in commercial real estate.
Sure. So where I'm from Long Island, New York, and moved down to South Florida in the late 90s before the COVID wave. So yeah, I'm an OG.
Early adopter, as one says.
Yeah, that's right. I'm an early adopter. And how did I get started in commercial real estate? So I got started in commercial real estate finance. I was actually this very nerdy quant working at a small fund, and I'd been solicited into residential real estate finance, and that kind of naturally. There's a lot of ums here, so I hope you have a fantastic editor. If they could remove the ums and make my answers more succinct. I
need that in my regular day life, so we're on the same page.
you better have a good crew. So it was a pretty natural transition into multifamily and commercial real estate finance. So I started a residential mortgage brokerage in the last cycle, and that became a commercial mortgage brokerage, commercial real estate investment sales, equity placement, title, and it became a full kind of suite of services. And I thought I was just the smartest guy in the world in my early 20s doing this, but I was riding a bit of a wave, and there was some humble pie on the back end of that. But that's how I got started in this business a couple decades ago.
Oh, I love that. I feel like a lot of people, especially the really great folks who are super successful, just kind of stumbled into there. So I love that you were taken into residential, then transitioned into multifamily. I also love the piece of the humble pie, which we'll definitely get into. I'm sure our listeners caught on to that as well. So kind of coming in, who were some of your mentors and how did they shape your career path, either early or later on in your career? Give us some insight there.
That's an interesting question. So, so that everybody knows, I was, I had an opportunity to prepare, and yet here I am, hearing all the questions for the first time. So I understand if you want to edit out half of what I have to say. So what was the
You're
question?
all
Who's my
good.
mentor?
You're
Who are
all
my
good.
mentors
Yes.
along the way?
Yeah. Who are your
Okay.
mentors? How'd they shape your career? Give us some stories.
Yeah. So different mentors along the way, certainly. And I think something that's been very important to me is where I get my mentors. So I have personal ones, like my father when I was young. And then there was this period of time where there was kind of no mentors. I was just a lone wolf doing it all by myself, which wasn't healthy, but it got me to a certain place in my career.
Mhm.
Uh, Later on, there's this fabulous guy, Marcelo, who's actually, on my board today. But really, where I've gotten most of my mentorship from, I think, is books. So behind me, if you could see right over here, that's Charlie Munger and Warren Buffett, and each of them. These aren't my boys. This is books and letters and things like this. So one of the most influential books I've read is Poor Charlie's Almanac.
Mhm.
So I think I've got a lot of this mentorship from reading, from biographies and what have you. And those two guys are my heroes.
Oh, I love hearing that. And I couldn't agree more, right? You have personal mentors, you have business mentors, but at the end of the day, everything that you want is kind of at your fingertips, right? With the books or the internet or things like that. So, really looking up the people that you admire and then doing that research on your own, I think can be super powerful if you don't have a mentor out there. So, I love that you just shared that, two really inspirational leaders right there. So, thanks for giving us that. In the other token, I know you said that there was some humble pie. So talk to us, were there any favorite mistakes that you've made early on in your career, late in your career that maybe help you pivot or just a huge learning moment in your life? Give us some insight there since you mentioned it.
So there's certainly no favorite mistakes. The big ones have all been quite painful. Fabulous learning
Yeah.
experiences. Mistakes in the last cycle. So this is around the 2008 era. Error. That's it certainly was for me. I thought I was just so smart, and I really credited the company's success to my IQ, which is wild, especially since it was built with people and on the back of an unbelievable cycle. So when the market turned and our pipeline evaporated overnight, instead of me stopping and saying, well, hold on, I've got to reassess, I just put all my chips in, and I was like, well, I'm just smarter than everybody. So, I've got this. And so that led to a bankruptcy in my early 20s, which was a very humbling experience. And there were other experiences along the way with leverage and other failures, which led me kind of down this path of mentorship where uh, I was looking to learn from everywhere I could, because I'd been through this, what my friend Ricardo called a yo-yo effect, where I had these high highs and low lows. So I definitely went on a journey to try to figure out what am I doing wrong? What's broken here? And there's nothing broken, but like, what am I doing wrong? What do I need to do better? What did other people do in these situations? How do I make sure this doesn't happen again? And so that led me to a place where I was, at a certain point, reading a couple books a week, just devouring information, trying to level myself up. No shortage of mistakes along the way, Ashley. It's there's a how do you call it? Is it like a weight in my wake? There, or just if you look behind, it's messy.
Yeah.
I'm trying to
The path to
keep
success
things.
is never linear, right? It's always up and down and back and forth. And, I completely agree with you there.
Do you ever see this thing where what people think success is, and
Yep.
then what success actually is, and it's like
Yeah.
this unbelievable squiggle, like
Yep.
just all over the place.
And it's like
Yeah,
the icebreaker that's like all the work that's down at the bottom, and then you just see this pivot up at the top, and that's
right.
absolutely not what it is. So
It is not.
appreciate you sharing, because there's probably some listeners, on our podcast that maybe have tried to create a business and it's failed, right? Or done a similar thing with bankruptcy. So it's just all about how you learn from it. And I love that, that almost became a motivational factor for you to then devour all of the information that you do have at your fingertips, right? That yo-yo effect. I mean, whether that's in our business life, our personal life, right? But there's always things that we can keep growing and learning upon. So I love that you just dived right in there and, kind of devoured the information that is here, which is exactly what our listeners are doing listening to you on our podcast. So again, thanks for sharing that.
I love that you love it. I love that you say that you love it and that you love it. So I'll share more. And I don't know. I would imagine that there's a lot of commercial real estate brokers, and every single commercial real estate broker is an entrepreneur, is a business owner, has finite resources within which he or she has to work, and it's transactional, and it's eat what you kill, which
Yeah.
isn't like the most lovely way to put it, but it is what it is. This is everybody is on this same journey. And my hat's off to everybody in commercial real estate, especially over the last year or so, and whatever lies ahead. It has not been easy. So everybody grinding it out, learning, growing. I'm rooting for you.
Oh, that's amazing. We absolutely need to hear that and just keep going, team. So this might have been, talked about, or maybe some of these early mistakes maybe led to, the creation of Janover. So I'd like to talk a little bit about that. Were there any decisions, key events that led to your company's creation? Can you share maybe the origin story and then how you got to build it into the successful firm it is today?
Yeah. So the key events involved my sister and my wife. If I lose it while I'm meandering through the story, you could just remind me. Um, so I was raising money, debt and equity, for a 130 unit Class A kind of institutional grade multifamily development in Miami. This is like a $50 million deal. So there was debt, and there was real kind of middle market family office equity, but an institutional type shop. And it took forever to put this deal together, not because of my incompetence, not that I was particularly competent when I was working on this 10, 12 years ago, but it was getting all the banks in America that it was a very odd deal, right? So it sounds clean, but every deal is a story. So this deal was very storied. Eventually we got the debt, got the equity, however long it took, a year, 2 years, it was crazy. And on the other side of it, I was like, well, gosh, I wonder if there's an easier way to organize all the banks, all the LP investors, and kind of make like a digital OM and flip deals to the people that it's in their credit box, update it, and just kind of digitize this process. Because even the best commercial mortgage brokers, they have an email list, or they have guys in their heads that they have relationships with, but nobody's really aggregated the data, at least as far as I know, in a useful way. So I started to build it at the behest of my sister and my wife. So I told you there've been ups and downs, and I was just coming off of what was a down, and I spent like a year living in a kind of remote location, or 2 years, something like this, in the middle of nowhere. And I came back to America to work on this deal, and I was like, that's it. I'm never going to have employees again. We're building this. And my wife and my sister were both like, come on, dude, you could do it. Don't be a wimp. You've got this. So I did it. And then I started this in, I think, 2019. So that was 5 years ago. We started building the software, and it took way longer and cost way more than we thought, but we got to the other side of it. And, now we're growing, building, on the NASDAQ, and still very, very small, still lots of room to grow and learn and improve. And we're by no means at the finish line, but it's been quite the journey so far.
Oh, that's great. So, having people in your corner, making sure that you're going for something is always a great form of just empowerment and then leads you to success. So that's awesome to share. Why don't you tell our listeners a little bit more about what Janover does, its mission, and then what needs it fulfilled in the market that were lacking before? So why you initially wanted to create it, and then give us a little more insight about what it does, how our folks can use it.
Yeah, so we really want to kind of enable the entrepreneurial spirit for commercial real estate owners. And the best way that we have to do that is with data, which I think is kind of somewhat similar to what Crexi is doing.
Mhm.
So we have our core business up until Q4 of last year has been debt. So instead of a commercial real estate broker, for example, going to a debt broker who's going to go to his three buddies or who's going to like email a list, we now have more than 10% of the banks in America on our platform giving us their credit box, 35% of the top 100 credit unions with bankers logged in, giving us their data, more than 1,000 other lenders. So we've become truly the biggest data source for all of these commercial real estate lenders. So in-house, we still provide the high-touch, hands-on, roll-up-the-sleeves type service. And it's, can we get better leverage for your buyer in order to make the deal happen for your seller as a commercial real estate broker? Can we, put on the white gloves and service your client the way they ought to be? And now, we're thinking, hey, maybe we want to license out this data too. So we'll see if that's something that we deliver on, giving commercial real estate brokers access to our entire back end. Haven't done it yet, thinking about it. And our
Ooh,
other
little insight. Okay.
so so the other two core services are multifamily commercial property insurance. It's the same thing. People have an insurance broker that gives them their car insurance. This is not the person to insure your 100-unit multifamily property or your large industrial development. There's just many more markets out there, and you kind of stack these insurance policies and create something more custom that's more affordable, that manages the risk better. And we own Groundbreaker, which is a investor portal for GPs. So if GPs are raising money from LPs, this is a login where LPs can go, see the deal, invest the money, sign the docs, ACH money in, get distributions through ACH and everything else. So we have the full suite of financial services for multifamily and commercial property owner-operators and developers.
That's wonderful. So our listeners, I'm
Thank you.
sure, are going to want your contact information and all of that, which we'll give them at the end for sure. But that's awesome. And you alluded to the fact that that's, what Crexi is trying to do as well, make everything in one platform that you might need to do to transact. So it seems like that's exactly what you guys are doing. Now, Blake, I know you gave us a little insight into potentially what you all are working on, but give us some details if you can share. What projects are you all currently working on, or alternatively, what are your favorite features or ones that you see bringing the most success to Janover clients?
Well, definitely touched on that. Going to your local bank or your local debt broker might not cut it right now. So us aggregating, being the biggest aggregate source of multifamily and commercial real estate lenders in the country, or building that platform where it's easy to search, match with lenders, send deals, get feedback. I think that's added an enormous amount of value. Favorite projects are definitely Groundbreaker. So this has been very cool. We bought them in Q4 last year, and you'd be surprised how many owner-operator developers are like writing out statements, sending them to clients, individually sending operating agreements to sign and PPMs and stuff like that. So this digitizes the whole thing. And I think I don't know what the number is, but I think our starting point is like $175 a month. So it's super affordable, and it's a fabulous tool. And on the insurance side, we have found that 100 plus unit, 50 plus unit multifamily property owners, there's just a lot of room to improve. And everybody's seen their premiums increase 50, 100, 200% over the last few years. So we're making a lower friction financial services around the commercial real estate transaction that Crexi is enabling. So Crexi is kind of enabling the buy, sell, the data, and we're enabling the other pieces around it. So I love us together. You and me, Crexi and us.
All the things, all the us,
all the things,
all the things. You and I. We're a team. I love it. And I promise listeners, I did not pay Blake to say that. Amazing. And then last, before we pivot into our second topic, anything new for the team that you want to share? How do you hope to shape the future of commercial real estate financing?
Look, I think that we have an opportunity to open up some of our back end at a certain point, giving commercial property, so investment sales, brokers, owners, operators, developers, empowering them with more data and more tools. And we're digging around about on how to best open that up. So in the interim, still, if you've got this is a super shameless plug, but if you've got a deal and you want to make sure the buyer is qualified, we'll pre-qualify the buyer, we'll pre-qualify the deal, and we'll get the buyer better financing. So sometimes that's the difference between, that's the binary difference on a deal, like the 0 and 1, right? Is sure. Can this guy get qualified, or can this guy get enough leverage or the interest only or whatever it is in order to hit his IRR hurdles in order to get a deal done? And sometimes it's an owner user, so it's an SBA deal, and there's 100% financing options with the SBA if there's real estate attached to it. So I think there's so much out there, and that's what we're good at.
Amazing. I mean, our listeners are definitely going to want to hit you up. So thank you for providing all of the information about yourself, company background, all of that. So interesting. So pivoting a little bit into just more of the weeds of the macroeconomic factors and the impact on the landscape of CRE financing. So just give us an overview. What does the current playing field look like for those seeking capital to invest in commercial real estate? So as an example, how are buyers approaching deals? How are they finding lending partners? What kind of terms are they seeking to negotiate? Give us kind of an overview of everything there.
It was a lot. I can't. Let me touch on what I remember from the 73 questions
that I just asked.
Yeah. I'm not taking notes. Clearly, I should be. So I think there's like a couple. There's a couple pieces to the environment for buyers that are doing deals, and there's debt and equity.
Sure.
So the guys that are well capitalized are good to go, and everybody says there's a lot of dry powder on the sideline. I've been hearing this for so many years, and I don't know what it means. I don't know how relevant it is. I think as long as there's good deals, there's money for them, and that's always been the case, except for the credit crunch. There was no money for good deals. There was only money for amazing deals, but the money was always there. So I think that you're seeing some of the syndicators that were born in the last 5 to 7 years or so, maybe like 3 to 7 years, are struggling with getting new LPs, because LPs have much higher expectations, and they may not be doing well with their banks, especially folks that have been that pull down kind of higher leverage floating rate bridge without a cap, which is, I don't have to tell the story. Everybody knows this story. So LP capital is kind of harder to get. Senior debt, the lenders that everybody had relationships with, like these relationships might have to change in the years to come, especially the regional banking relationships, the community banking relationships. Just some banks are filling up, and it doesn't matter how good the relationship is. It's like, hey, not only can we not finance the next deal for you, but we also kind of need you to take this deal off our books. So it's been transactionally, I've seen in different cohorts of the business, volume drop 40, 50, 60% year over year, especially last year, which obviously makes it harder on those that are kind of facilitating those transactions. I think the power kind of lies in access. So if you've got a long track record, with that long track record comes a lot more relationships, many more banks, many more LPs. And I think those guys have kind of a bit of a competitive advantage. There's still a bid-ask spread, which didn't exist 2 years ago, and now it's there in different quantities in different submarkets and asset classes. And again, I guess this isn't something that everybody here that's listening doesn't know, but yeah, it'll be interesting to see what the tail end of this year looks like. I think that there's GPs that I feel for and LPs that I feel for. There's probably a good amount of LPs that don't really know what's going on with their GP. So if you're a GP, communicate. It's a tough conversation to have, but have the conversation. Yeah, I don't know if I even answered. I don't even know if I was in the vicinity of your questions. I just started.
You were. That was
okay.
that was perfect. That was a really good 30,000 overview for both sides of the equation here. So love to hear those insights, and I completely agree. I mean, some of the hardest conversations are the ones that you have to have. So I think that's a really good advice right there. Regarding some underwriting practices, how are appraisers or lenders adapting their analyses to the current market? What do you think are the biggest factors that are most important in these calculations, and why?
I don't want to answer the appraiser question because I don't think I have really useful insights. I think they have a tough job.
Mm-hmm.
On the bank side, I think that they're going to be. So it's very institution dependent. Is it okay that I chose not to answer one of your questions?
Fine. Absolutely, totally cool.
I'm a rebel.
Without a cause.
Yeah. No, I've got a cause.
We've got a cause. We don't want to answer it. Protect ourselves at all costs.
Yeah, that's right. To protect my bio that you laid out here, where I'm smart and I know what I'm talking about. No, it's just I think on the lending side, it's going to be very sponsor centric. It's certainly deposit centric. It's very institution centric in what their exposure looks like. So it doesn't matter how good the deal is. Some banks are just like, hey, I need to pull back my office exposure, or we want less multifamily and commercial on our books. But those same banks are lending to lenders who are lending to those borrowers, because I think that doesn't kind of really count as that direct exposure that they're getting dinged for.
A little workaround. Okay.
Yeah, I think you're going to see a lot of it, and I'm surprised a lot of it that was happening before hasn't really bled back into this market. So I think that all of the traditional stress tests continue, right? The real differentiator is the sponsorship, is the guy signing the personal guarantee or the carve out or the carve out guarantor. And if it's a bank loan, it's deposits. If it's CMBS, it's debt yield. If it's Fannie and Freddie, it's the same underwriting it's kind of always been. But the place that's really kind of dislocated has been that regional bank piece.
Mm-hmm. Yeah, appreciate those insights. So talking a little bit about the Fed's rate hikes. So just how significant do you think the impact of that has been on the commercial real estate market in general?
Super significant.
Mm-hmm.
All the significance. So,
is there any segment that has been affected more than others, certain asset classes, anything like that in your opinion?
So my boy Warren Buffett back here says that interest rates are financial gravity. So I think any financial asset that's like coupon cutting, especially that produces a cash flow. The longer duration the cash flow, the more significant the hit interest rates has kind of had on it, and that goes for everything from commercial property to a bond. So there's nothing that's kind of unaffected by it. And I don't know that. So certainly parts of the market have been more abused, right? Like office, but I don't think it's necessarily interest rates that created the greater abuse. That's more of like the COVID thing and the work from home thing, which, by the way, not that you asked, but I don't know if I'm maybe I should be, but I don't know if I'm as bearish on office as the rest of the world is, where it's just like it's all going to turn into a storage unit. There were these periods of time for retail. It seems like every decade where it's like retail's going away. Online sales, Amazon retail's going away, COVID retail's going away. So nothing ever kind of is as good or as bad as we think it's going to be. So I think there's probably going to be office on the other side of this. Interest rates have been brutal. I mean, it affects everything. Like every DCF was just turned upside down. I'd love to see rates come down, and there's all kinds of repercussions of rates going up and down. And we'll see what this turns into. And not everything's kind of been pulled through the system yet, so we don't even really know the extent of the damage that's been done.
Right.
But I suppose we'll find out.
We will. And just speaking with that, I mean, a lot of sellers today obviously want 2023 pricing, but buyers want, 2024 rates. What are you seeing occur in the deals that are happening right now?
Somebody needs a deal. So either the seller's has a capital call, has another deal that he wants to do. There's some tax situation. So some series of things where that seller's like, fine, I'll do it. Or on the other side, buyer's got capital to deploy, buyer's got fee income associated with that capital, and they got to get a deal done. And then you see deals that are upside down. And I think you see more of that. I think you see more of buyers that are willing to go negative leverage than you see sellers that are willing to take the L.
Yeah, I mean, that kind of comes into my next question and bigger point. So for specifically loans that are maturing either this year or next year, how are current owners approaching these situations? Are these borrowers going to be able to refinance, in your opinion? Why or why not?
So it depends on the borrower. Which is just like a lazy answer, but I think a lot of the deals. So all commercial mortgages and multifamily loans are generally balloon notes. So I think you'll find that loans that have been made over the last 10 years, 7 years to multifamily, industrial, all of these things have benefited from inflation, and their top line grew faster than their expenses grew, and their NOI materially improved, and you've got and you've got generally much healthier deals. They're not worth what they were worth in 2023 because of cap rate expansion, but they've improved materially from when they were originally financed. The guys that are in trouble are not the guys that are necessarily in trouble, but the higher risk cohort is the construction loan from 2 years ago, 2.5 years ago, the floating rate. I'm going to, kind of paint the building and get cap rate compression, high leverage, no interest rate cap. They're going to have a harder time. And even office, that's performed really well just because it's out of out of vogue. Is that the right way to say it? I don't know if that's the right way to say it. I really want to use the word vogue, so I did that. It's out of style. So office will be underwritten much more conservatively, and there'll be a little more pressure there, especially this like urban B
Mm-hmm.
and C type property.
Yeah, I appreciate giving us all of that insight, both 30,000-foot overview and then diving into the product types. That's really beneficial. There's a lot of talk about delinquencies, but what are your lending partners currently telling you right now?
So there's plenty of delinquencies and there's plenty of extend and pretend. Um, there a lot lands on these GPs where they're given the option of put more capital in the deal and we'll extend it, we'll play with the interest rate, we'll do all these things. But if you don't, we're taking it. And I think there's a lot more of those tough conversations happening now than were happening before. And GPs are having to determine, if I make a capital call, will my LPs pay it? Should I make a capital call? If it's fund based, it's should I put in my own money? And these are really tough decisions. And I'm seeing both be made. So I'm seeing GPs add the additional capital, preserve the relationship and the property, and stick around. I'm seeing GPs hand the keys back, and the lenders aren't really out there telling the story. It's GPs that are kind of like willing to share what's going on, and it sucks. It's even for those of us that kind of knew interest rates like had to go up, or like it seemed very high probability. The velocity at which they moved was shocking,
Mm-hmm.
not just to the financial system, but to the financial assets that are such an integral part of it. Multifamily commercial real estate being like a meaningful piece of that.
Yeah, and appreciate you sharing that. So kind of, we've been seeing a lot of rise in bankruptcies, right? So we've seen a 16% rise in filings as of April 2024. So looking at the details, what percentage of these are developers or CRE owners who are unable to refinance, in your opinion?
I have no idea.
No worries. No worries.
Serious.
I mean, you kind
That's
of touched
the
on it there. I mean, in the prior question, I mean, a lot of issues with this right now, and a lot of people, giving back keys or needing to go get more capital. So, I mean, would be probably, a high percentage if you don't have an exact number, just based on what you're saying here.
yeah. If those are bankruptcies related to commercial real estate, there's there's the I can't refinance cohort,
Mhm.
which is I guess most of them are going to be there, and it's either going to
Yeah.
be it was a short term value add deal or it was a ground up deal,
Hmm.
um, and maybe some like B and C office. I've seen hotel deals popping up more
Yeah.
and more, like really high quality,
Hmm.
uh, like first class names that are negative DSCR because of the floating rate
Hmm.
that kind of ripped up on them. So there's anybody that had a floating rate that didn't have a meaningful cap
Yep.
is I think you'll see a lot of those, and obviously the construction stuff is mostly floating rate. So
Hmm. We're seeing a lot of hotels actually going to auction right now because of that. So I couldn't agree more. Our auction team is getting a lot of hotel deals. So um, in terms of any advice that you would give potentially to stakeholders who are trying to find any debt relief, is there anywhere that they can look, or how are they potentially working with their financing team to overcome this?
if you're if you have existing debt and you've got a problematic deal, the best place to go is to your lender. and it's to communicate. And if it's a bank specifically,
Mm-hmm.
some non-bank lenders are just kind of want the property. And in that case, you have to determine, do I want to inject capital? Do I want to do some funky rescue equity structure where I'm going to cross some other assets? Do I want to give it back? But if you've got a bank, especially like a regional bank, tell them everything. Communicate super openly and clearly with them. I think there's kind of a bit of I don't want to say a mandate on banks, but I think banks have gotten the message from higher up, which is try to resolve this stuff. Do not do what you did in 2008. Like, we don't want that again. Work with the borrowers. And I think the banks really will. And you're going to get a different level of work with from different banks. I don't know if your CMBS lender is going to work with you. Good luck with your special servicer, but your bank will probably work with you. And it starts with open, honest, transparent communication. If you've got equity and you want to get away from the deal, you could send me an email and I'll pull in the team and we'll just talk to every bank instead of just yours.
Good deal. Well, appreciate you sharing, financing team, how we're working with banks. And then obviously all of our listeners have the opportunity to call you if they're in that situation. So appreciate that there. I kind of mentioned and alluded to the fact a little bit about the auctions. So how do commercial real estate auctions play into this world? So in your opinion, why would they not be valuable as a tool for stakeholders who are facing financing troubles, or maybe even those with healthy assets?
Look, first off, there's a guy at Crexi, Paul Cohen. You have to share his contact information for me, and you could plug it now at the end of the episode, whatever. But Paul's a legend, and I think I'm pretty sure he runs the auction practice at Crexi. So I think auctions are a really powerful tool that are underused. And if you have the data and the market, you can get better than what the market is, better than what you could get through a traditional listing. Because there's these elements of, there's all these like psychological elements like FOMO and time and minimum bids and there's a million different ways to skin that cat. And there's a reason that Sotheby's and Christie's and all these places are super successful. And I think 10X had an idea there that had legs. So I think it's an underappreciated, underutilized tool, the auction. And when you've actually got a timeline, then the best deal you're going to get, if you have a proper run auction and you've got 60 days, 90 days, the better option than giving the keys back, may very well be to run an auction and see if there's some alpha there. So yeah, but Paul Cohen for president, or at least for auctions.
PC is definitely amazing. So appreciate that plug there. Crexi will run a ton of different auctions. So we'll also give all that contact information for anyone listening that wants more information about that. How would you give some advice, or what would you say to current owners with upcoming maturities in the second half of 2024 or beyond? What would your advice be?
Send me an email, Blake@Janover.co. I'll pull in the team. It's like a little tongue in cheek, but the reality is that your bank, your existing relationships, maybe your debt broker, it might not be enough. And back 3 years ago, when the difference between two deals was 25 basis points, it didn't matter as much. Now it's 75 basis points, recourse, 10% leverage, a different debt yield. Maybe there's interest only. There's just there's just so many different elements, and it's so complex. Getting the best deal, I think, is a very low probability event unless you go to a very, very broad market right now. So, Ashley, I appreciate all the opportunities you've given me over the course of this conversation to promote myself. And I feel guilty each time I do it, but Like that's what we're here for. And by the way,
Absolutely.
insurance too, and your investor portal.
It absolutely is. Like, I mean, that's why we have folks like yourself who are super successful in all different industries, right? Our listeners want this information. They want to be able to connect with you. So appreciate it. You heard it here first, listeners. Definitely don't hesitate to connect with Blake. I'll have you I know you just gave your email, but give us your social handles, anything else, phone number, email once more. Give it all to our listeners right now.
Right now, right this second?
Yes.
I forgot everything. I forgot it all. No, I don't know if I have all the socials. It's so I don't have a Snapchat or a what's the there's a lot of these things, but
you don't make the TikTok dances?
I don't have the TikTok.
Blake.
I don't have the TikTok. I don't have the Snapchat. But you could. I feel like this must be said every time you ask somebody for socials. So I'm totally unoriginal. But LinkedIn is my name, Blake Janover, BlakeJanover. My email is blake@janover.co, not .com, not .net, not .ai. It's .co. And that's enough. I'm certainly not handing out my phone number. I don't pick up anyway. So, but I'll insta answer your email. Send me an email at 4 a.m. on a Sunday. Text me.
Perfect. All right. Some people might do that. So be careful what you ask for.
I'm sorry to hear that. Yeah.
All right. Our third topic. So this is the most fun one. Given your background and expertise, I'm sure our listeners are curious about your answers to a few rapid fire questions and words of advice. You game?
Do I have an option? Yeah, I'm game. Let's go.
Nope.
LFG.
All right. First, if you were given $50 million today and had to invest it immediately, what would your go-to asset type and location be, and why?
So I'm investing in commercial real estate, essentially.
Yep.
Okay. Because $50 million, I might drop that in a 10-year treasury and go to the beach. So what's my choice asset and what's my choice location?
Yep.
I'm going to get creative. I'm going to say tertiary market data centers.
Love. Okay.
Yeah, I'm going to buy the land for cheap. I'm going to build the data centers. Yep. We're going to fill them with NVIDIA chips, and we're going to lease them to Google and Microsoft.
Amazing. I'll be in that with you. Second rapid fire question. What is your favorite tool or software you use on the job? And I promise this is not a trick question or promoted question.
No, I want to plug myself, but it's GPT-4o. And the second most important tool is Crexi.
Amazing. Okay, good deal. And then third, what is the most common misconception about your job or industry?
I'm processing it. I know this isn't a rapid fire response.
This is a slow burn.
I don't know. It's like incense. I don't know what people think about my job, so I can't respond to that. And what's a misconception about my industry is that when I say commercial real estate, people are like, "Oh, office buildings in New York," and like, no, it's self-storage in Alabama. It's Class A apartment buildings in Dallas, Texas. It's a data center in Ohio. It's an assisted living facility. It's industrial. It's retail. It's hospitality. It's a Four Seasons. It's a Howard Johnson's. So that's my answer.
Yep, I couldn't agree more. Well, thank you, Blake, so much for joining us and sharing your insights. I know you're very busy, so we appreciate you spending time to sit down with us. So already gave everyone your socials, contacts, all of that. Any last parting words of wisdom, advice, anything for our listeners here today?
I advise everybody continue to listen to Ashley Kobovitch. She's a star. She knows how to run a show. She just did an episode and made me look good, which I imagine can't be easy. It probably required a lot of prep. So Ashley, thank you for having me. Crexi, you're wonderful. And I guess you're going to eat co-stars lunch. Keep at it.
I I absolutely love it, Blake. Thanks so much for the kind words. We genuinely appreciate sitting down with you. This was so fun, and it's very easy to make you look good. So don't worry about that at all. And thanks to everyone who tuned in today. If you enjoyed this episode, do not miss the next one. Visit crexi.com/podcast and sign up to get the next episode delivered straight to your inbox. Of course, you can also subscribe to the Crexi Podcast on your favorite podcast app and check out our YouTube channel for video recordings of each episode. Take care and be sure to tune in next time.